Hi, welcome back to Chapter 14, Part 2. In this section, we'll finish off our discussion of long-term financial liabilities by talking about some of the more complicated situations that can occur for long-term bonds payable or notes payable. Our first learning objective is to understand when long-term debt is recognized and derecognized, including how to account for troubled debt restructurings. Extinguishment of debt is recorded when the debtor pays the creditor or the debtor is legally released from paying the creditor due to cancellation or expiry of the debt, etc. When debt is extinguished, it is derecognized from our statement of financial position. If the debt's held to maturity, the carrying value equals the maturity value or the face value, the same amount that if we settled it regularly, so there would be no gain or loss. The face value equals the market value at the time. So there's no gain or loss. So basically, like you have a bond on the statement of financial position for $1 million, you settle it for $1 million, no gain or loss, it's simply extinguished or paid back. There are situations where debt will be repaid before the maturity date. So when this happens, the amount that's paid is called the reacquisition price. On any date, the carrying value or the carrying amount of the bond is the maturity value plus or minus any unamortized discount or premium and issuance costs. So just thinking about that statement of financial position, which we've seen from some of the tutorial videos, if you're doing the effective interest method, you've got your table set up so you know what the current carrying value of that debt is on your statement of financial position. That is the carrying amount of that debt. If the carrying amount is more than the reacquisition price, then there's a gain from the extinguishment because you're paying less than what you're carrying it for. But if the reacquisition price is more than the carrying amount, then there's a loss. So obviously, you know that you need to true up the debt to whichever it's being extinguished at. So if you're extinguishing it for more than you're carrying it at, then obviously that's bad. There's a loss. But if you're extinguishing it for less than what you're carrying it at, then you're going to have a gain. At the time of reacquisition, all outstanding premiums, discounts, and issuance costs are amortized at the date of reacquisition. So let's take a look at an example. On January 1st, 2020, a company issued bonds with a par value of $800,000 at 97, which is net of issue costs, due in 20 years. 8 years later, the entire issue is called at 101 and canceled. The straight line method is used. Well, what we need to know is, first of all, is what the reacquisition price is. So what is the debt being called at? We're told that it's being called at 101. So 800,000 times 101 is the net carrying amount of the bonds that are, is the net carrying amount of the bonds. So the bonds are being called at 101. Or sorry, 808. I apologize, 808. Then what was the net carrying amount of the bonds on our statement of financial position at the date when they were called? Well, we know that originally the face value was 800,000. And then we would have been amortizing the discount that we recorded initially, because it says that they were issued at 97. So we would have been amortizing $24,000. This is 12 out of 20 periods. So just doing some math to figure out what our statement of financial position would have looked like. 8 years later, when the issue was being called, we would have amortized already $14,400 of the $24,000 discount. So the bonds would have been on our statement of financial position at that point, 8 years later from issuance, at $785,600. And they're being called at 808. So we have them on our balance sheet at $785,600, and we need to extinguish them at $808,000. So that's much higher than what we have them on our statement of financial position at, meaning we need to record a loss on redemption of $22,400, the difference. Debt instruments can also be exchanged. So this is where an existing debt is replaced with a different debt, and this is called refunding. The exchange of debt instruments that have substantially different terms is where we remove the old debt from our statement of financial position and we record the new debt. Troubled debt restructurings occur when, for economic or legal reasons related to the debtor's financial difficulties, a creditor grants a concession that it would not normally offer. And there's two types. There's settlement of debt at the carrying amount, and then there's continuation of debt with term modifications. Settlement of debt is where old debt and all related discounts are derecognized, and there's usually a gain if the creditor is making a favorable concession. Like if they're saying, listen, we'll give you an extra 5 years to repay the debt. We know you can't repay it right now. That would be a favorable concession. So normally there would be some sort of a gain recognized by the company in that situation. And the means of settlement, sometimes you can transfer non-cash assets or make a share transfer. So here's an example of that. So Citibank accepts a fair value $16 million building in settlement of debt. The building is recorded at $21 million, net of accumulated appreciation of $5 million, depreciation of $5 million. So, so the accumulated depreciation is $5 million. The note payable was for $20 million. We've got the loss on disposal of the building. So 21 million minus 16 million is 5 million. So basically, we're just basically replacing the debt with the building. And you can see that there's a calculated gain on the restructuring of debt just because that's a favorable transfer from the position of the company. And you can see all accounts for the building and the note are derecognized, and they're put back on the statement of financial position from square one. Here's another situation. So Citibank accepts 320,000 of common shares of Union Trust with a market value of 16 million in full settlement of a $20 million loan. So we're going to obviously remove the loan or the note payable from the balance sheet or the statement of financial position. So you can see we've got a debit to the note payable, removing that. Then we're recording the common shares of 16 million. And then there's a gain there of the $4 million difference. If a debt settled by substantial modification, so in some cases, a debtor may request modifications on the original contract or agreement. So things like reducing the stated rate of interest, extending the maturity date, reducing the face amount, etc. And if there are substantial modifications, the transaction is treated like a settlement. And in order to meet this criteria, the discounted present value of the new terms have to be at least 10% from the discounted present value of the old terms. So basically, if there's a difference in the present value of greater than 10%, then we're going to completely derecognize the old debt, put the new debt onto our balance sheet. And this will often result in a gain or loss to the company. So that's the key criteria, is that 10% threshold. If that 10% threshold is not met, then it's not a substantial modification of terms. And that means the old debt continues with the new terms. So meaning that you might need to recalculate the interest rate, or you're going to change your schedule kind of in the middle of the debt. You're not going to simply remove and re-put on the old debt, or sorry, remove the old debt and re-put on the new debt. IFRS, the debt is remeasured by discounting the new cash flows at the original effective interest rate. Defeasance, we talked about this earlier in part 1. So legal defeasance is where the creditor looks to the trust for repayment and the creditor no longer has a claim on the company. And if you're able to achieve this, where the company hasn't actually repaid the bondholders, but they've set up a trust and the bondholders have agreed to get payment from that trust and release the company from the liability, then we can treat that like an extinguishment of debt and remove the liability from the statement of financial position of the company. If there's in substance defeasance, that means the trust is there, but the bondholders haven't agreed to release the company from the liability. So the debt is not derecognized from the company's balance sheet. Off balance sheet financing. So this is an attempt to borrow funds in a way that the obligations are not recognized. So like non-consolidated entries, special purpose entities, maybe operating leases under ASPE based on some of the recognition criterias. I'm sure many of you are too young to know too much about this, but this was a big issue in the Enron case, where there was off-balance sheet financing and the liabilities weren't showing up on the company's balance sheet. So the creditors of the company were not aware that the company was so highly leveraged. So this is definitely a hot issue. And there's many accounting standards over the last 20 years have been put in place to ensure that off-balance sheet financing is incredibly, if not impossible to achieve. Okay, so that completes learning objective 3. Learning objective number 4 is an analysis objective. So it's our last learning objective, or our second to last, I should say. We have one other quick learning objective, but this asks us to explain how long-term debt is presented, disclosed, and analyzed. So we're going to look at some ratios. So the reporting of long-term debt is controversial, meaning that there's some changing definitions in liability and recognition, and there's not a really precise definition in the conceptual framework. But long-term debt that matures within 1 year, we know that's going to be current on our statement of financial position. And if the debt's going to be refinanced, it's going to be current if we know it's going to be refinanced or something's going on with it in the near term. And most statement of financial positions, or some statement of financial positions, I should say, present assets and liabilities in order of liquidity. And financial instruments, debt instruments where it's mixing with debt and equity especially, are becoming a lot more blurred and can be more complicated to account for. Disclosures for long-term debt. So there's significant disclosures required. Obviously, IFRS is going to have more disclosure requirements than ASPE, but both have significant disclosures. You need to explain the nature of the liability, maturity dates, interest rates, call provisions, conversion privileges, restrictions, assets pledged as security, the fair value, anything complicated about it, maturity amounts, and any sort of risk related to the debt. In terms of analyzing the statements, something that analysts, creditors, or shareholders will do is look at a company's solvency. So one way of thinking about long-term debt here, or analyzing this from companies' public financial statements, is by looking at the debt to asset ratio. So this measures the percentage of total assets provided by creditors. So this is where you would say you would take debt to total assets. So you'd take the total debt and you divide it by the total assets, and it'll give you a certain percentage of how much of the assets are being financed. There's also a times interest earned ratio, which is where you take income before income taxes and interest expense, and you divide it by interest expense on long-term debt and see what that looks like. And this is going to indicate a company's ability to meet interest payments as they become due, making sure that they have proper income to be able to support the level of interest payments that they've committed to. IFRS and ASPE, so they're largely converged as they relate to long-term debt. There's very small differences, but more or less there's not major differences between IFRS and ASPE. Of course, really important, something that we covered earlier in the chapter, is that IFRS requires the effective interest rate to be used when amortizing a discount or a premium. And ASPE permits the straight line method, but companies can elect to use the effective interest rate method if they like. The advantage to the straight line method is that it's much more simple. But yeah, a private company can elect to use the effective interest method, but any sort of a public company or any company reporting under IFRS must use the effective interest method. So that's a really important difference. Our last learning objective, differences between IFRS and ASPE. Okay, so looking forward, the IASB is working on a project that will affect how debt and equity instruments are classified and presented. So again, that blurring of debt and equity, which we haven't talked about a lot in this chapter. We will talk about it briefly in a further chapter, but debt can be simple when you're looking at just a bond payable or a note payable. But when you've got a conversion option into equity or security provided by shares, it can be like, is it debt, is it equity? And that's where things can get more complicated. And that's something that the IASB is continuing to work on, making sure that it's clear. And that's it. That concludes chapter 14. Please join me for the tutorial section for chapter 14, part 2.